Well, good morning, everyone, and thank you for joining our session on international investing. My name is Joe Witthohn. I'm product development head of a company by the name of Emerald Asset Management in Lancaster, Pennsylvania. Now, let's face it. Once upon a time, the world economic engine was going strong, and the way that people thought it should be. The U.S. manufactured and sent high-quality goods across the world. Labor-intensive industries located in low-wage countries, they fed growing U.S. demand and demand across, well, the entire world. All was well in the middle class. The middle class was prospering on a global basis, but rapidly and suddenly, things changed. The U.S. had a financial crisis, and the solution? Let's print money and make easy borrowing available. Europe soon followed with a financial crisis of their own, and soon they were printing money too. Soon, printing money as a solution to the world's problems became quite fashionable around the globe. And it brought debt loads to historic levels. The world recognized that something had to be done. So what was decided? Too much debt? Let's introduce austerity. Austerity? Well, people get fired. Programs get cut. Well, people get fired, higher unemployment. Higher unemployment? People, voters, protest. People protest. What does the government do? They increase borrowing. And the cycle continues on and on and on. Yeah, the world's having some issues, and many are naming the U.S. as a safe haven place and to ignore international markets. But is this a wise move? Is the world getting austerical? That was a little fun. Nice. Thank you very much. I thought that was a pretty good one. Thank you. So today we have 4 experts in the international arena as our guests. They're going to offer their views in international investing, including comments on emerging markets. So I've asked each to introduce themselves, speak a little about their firms, and give reasons why we should be riveted to our seats for the next 40 minutes or so and listen to their views on the international markets. And we'll go in alphabetical order and start with you, Bob.
Thank you, Joe. Good morning, everybody. I'm Bob Carey with First Trust out of the Chicago area. We are the largest unit investment trust sponsor in the country, and our goal is to be the largest ETF sponsor eventually. Give us 50, 60 years, we might do it, but it's great to be here.
Good morning, everybody. My name is David Gatti with Risk Paradigm Group, and I think first I'd like to just thank IMN for including me on this panel. It's an honor and really a privilege to talk to all of you, I think the champions of this industry. Risk Paradigm Group, my partners and I founded Risk Paradigm Group. As you can tell, risk is the first word in our name. We're pretty focused on it. We wake up every morning thinking about left tail risk, and we really want to be leaders in the paradigm shift of how risk is defined, taking it from the way institutions define it and bringing it towards the direction where investors define it, which we view as max loss or max drawdown, loss of capital. So that's what we think of with every solution, a financial solution we create. Every one of the SMAs we run or the mutual funds that we run has an eye or an explicit view on risk.
Hi, I'm Tim Seymour. Thank you, Joe. Thank you, IMN. And by day, I'm a hedge fund manager. I invest in global emerging markets. We run a long-short fund. I've been in this asset class for probably 16, 17 years, having lived on the ground in some of the funkier places that people call emerging markets. As I say, we're by day we're stock pickers. We are trying to find great management teams and those that are creating value, and find those that are relatively attractively priced. In emerging markets, that's actually a pretty interesting exercise because I think there's a great opportunity to do long-short. And I think a lot of people don't really understand that. I know we're going to talk a little bit more about some of the things that are driving these markets in a bit, so I'll leave it at that. By evening, you may see me on CNBC on Fast Money, where I try to talk as much about global markets as I can in the context of a discussion that's usually very U.S.-centric. But I also run a site called emergingmoney.com, which is, I think, an attempt to try to reach a retail audience and a high net worth self-directed audience to how to better educate on investing in these markets, what types of products, give people some actionable ideas, and hopefully both dispel the myths about investing in these markets, but also give people, I think, some kind of 101 opportunities for moving forward.
Well, thank you also to IMN, to Joe for leading this panel and my co-panelists. My name is Mark Sladkus. I run a boutique registered investment advisory firm in Manhattan called LIGHTHOUSE. We invest globally. What we do is pretty simple. We're passive. We invest to capture the risk factors of size and value, global on the equity and the fixed income side, and look forward to this panel.
Well, thank you very much. And one of the things we're going to do, even though I have some questions prepared, we want to make sure that, please recognize this is your panel, basically. It's not ours. So if anybody has some really intriguing questions that they really need to have answered, don't want to wait till the end when I tell you that we've run out of time, just feel free to raise your hand at any point, and we'll get to your questions immediately, instead of listening to my boring and planned questions that the panelists already know well in advance and have probably rehearsed. So anyway, Bob, yesterday France elected a socialist to head the country. And what was actually a vote against austerity he was picked. And likewise, an anti-austerity party in Greece seemed to have upset the apple cart over there also. Can you give us your view in this backlash against austerity? I mean, what will the votes mean now that the area called the Eurozone and all the other countries in danger of political and economic upheaval?
Well, Joe, we also had regional elections in Germany as well yesterday, and those election results suggest anything but austerity is in the minds, at least among German voters. I'm not so sure that the French election per se was a referendum on austerity as much as it was just the fact that the economy in France has deteriorated significantly here in the last couple of years. Unemployment's gone up massively, and austerity may have motivated some factions within the French electorate to vote the way they did, but I submit that pretty much it's a reflection of the fact that the economy was just simply not performing that well, and I think very, very much an anti-incumbency election as opposed to any particular ideological twist to it.
Well, thank you. And David, you've had many years of international experience, and you know how different the countries in the Eurozone are with regard to resources, customs, etc. Yet all of them share a common currency. The euro, which some say is in danger of collapse. And in your opinion, can diverse cultures share a common currency? Or as Joni Mitchell says, is this a dream some of us had?
I love the Joni Mitchell reference, right? I'm just gonna go with the modern monetary system. I think, in trying to, it's like herding cats, really, in Europe, and you've got very different cultures. I mean, think about the history of Greece and Germany, and here we are at a period of time in the history and the evolution of the economy in Europe, and you've got kind of historically hostile communities against one another, one looking for capital to be released from who's controlling, which is really Germany. I think on the other side you have economies like the U.S. and Japan, and it's are we being silly to say that we have it right? We continue to print, and so does Japan, but you really haven't seen a ton of growth out of Japan as well. Or the U.S., yet you've seen our currencies against gold continue to go down for the last 10 years. At times when I'm asked about really G7 or the Euro region, I kind of think back, I think to why I'm in the emerging markets, and I think of how the decoupling is really taking hold. And here we have, India going from 8.5% growth to maybe 6.5% growth, which I think is maybe a bigger impact to GDP output than many are really giving credit for right now. And I think that's the story. I think really the story, if you think about the BRIC nations, they create an Italian economy every year. Here in 2012, they're going to have the same output as the Italian economy. China alone will, create a Greek economy every 11 and a half weeks. I think that's the story. And here we're focused on a area of the region that is professional, kicking the can down the road. So I think this is again buying time, but at the end of the day, we're really focused on the decoupling and the dispersion that occurs in the emerging markets.
Well, Tim, I know your expertise is the emerging markets, and we'll get to that, but I'd really like your opinion on this. You know, remember the Eurozone started with great fanfare. Everybody was very excited. Okay, one trade zone, et cetera, and so forth. Is it an experiment that basically has outlived its usefulness?
No, I don't think so. I mean, I think it's a trading bloc. The EU is got a very much aligned interests. I mean, these are mature economies. In many cases, they're service economies. Having said that, there's a periphery. The Eastern European periphery is I think, very industrial. So aside from Germany, which is the most industrial probably of the G8, I think, you know, as we've already said on the panel, the problem is that, I mean, the French have paradoxically voted in a socialist to fix socialism. And you know, I think you're going to continue to struggle on what we all know is a structural, legal and political construct, not an economic one. I think the economic construct is very, very viable, very useful. So the problem is that for markets, there's a couple things going on. I mean, one is that we are going to be plagued with tape bombs for the next 3 to 6 months. I mean, the best thing that can happen right now, first of all, is that Greece forms some kind of a coalition government, and it's probably going to be June elections again. The French have legislative elections in June, which are much more important than this presidential elections because they will basically give you an indication of whether Hollande can have the capacity to rule and have a majority to get any legislation through. But more likely, we're going into September to understand how the Troika is going to deal with Greece and some of the factors. You know, and as Bob pointed out, I mean, there's Germany's got major elections going on, and I think Merkel is struggling right now with her political constituency. So, yeah, I mean, the experiment was definitely ill thought out to assume that the political processes here could ever be synthesized. But I think from a markets perspective, again, the LTRO has put a backstop on systemic risk. What I think the bigger risk is right now is into the end, in the middle part of June, is that European banks have to do a massive amount of deleveraging to get their balance sheets in order. And for markets, this is very disruptive. And this is what we as managers in the market find very frustrating because it doesn't matter what's going on fundamentally. And it doesn't matter when you pick stocks, when you see these waves of deleveraging. And by the way, a lot of the European banks have been investing in through and have lent money to emerging market financials. And so that transmission of monetary, you know, communication essentially to the emerging market world is one that's going to create some problems. I mean, Asian banks are largely funded by European banks. And I think as managers we have to be aware of that. It's very difficult to plan for that.
Well, thank you. And Mark. Hi, Mark. How are you? You know, you're responsible for the creation of many international indexes for MSCI. You know, and you should, of course, be commended for your work because you've done a great job doing that, obviously. You know, but we see individual countries blowing up. I mean, Greece, Italy, Spain, Rhode Island. Oh, did I say that? You know, and we have others doing fairly well, such as Germany. You know, in times like these, you know, does active management actually make more sense than a passive approach? You know, because indexes force you to own some countries that keep you up at night when all of a sudden you hear the news and you say, oh my God, it's in my index, I'm forced to own it. Well, if you were an active manager, you might be able to say, you know what, let's head for the hills, Betty, it's time to pack it in.
So let me ask a question. This is unplanned, I hope you don't mind, but how many in the audience think this is an above average time to invest in Europe? More than I would have expected. So about a week after March 9th in 2009, I was on a panel and I asked the audience, you know, who thinks it's an above average time to invest in risky assets such as equities? And one person raised their hand. It was an institutional audience. I make no predictions. I don't forecast. I don't move in and out of regions or countries based on anybody's predictions. I'm skeptical of that. But I think that as we get gloomy about growth forecasts in Europe, one should be aware that study after study, you know, Vanguard did one back to 1900, shows there's zero correlation, actually slightly negative correlation between growth in GDP and equity markets. It's kind of a non-counterintuitive thing. So going back to the question, it would be great if I felt that instead of taking a passive approach, I could avoid the bumps up ahead. I just don't think I can do that, and I guess I'm skeptical that others can. And that's why I favor a passive approach to it. And, you know, we'll look back and a couple years from now, we might find that this was a great time to invest in Europe. We might find it's not. Once again, I'm not trying to make those judgments. I just think that on the margin, news doesn't have to be good. It just has to be better than the news that's already baked into it. And there's certainly a lot of bad news baked into the markets, particularly the European markets these days.
Well, one of the questions that we just had answered, basically, Bob came up and talked about the election in Germany yesterday, and it really struck a chord, because you can imagine the people in Germany, all of a sudden, a few years back, they're asked to sit there and make great sacrifices and start to help support East Germany, because they were combined and brought over. And you can imagine that the Germans are saying, well, we have our aunts, uncles, friends over in East Germany, so we'll be glad to sit there and take some sacrifice and do it. Okay, so now all of a sudden you have the German economy doing well, and the Germans are now asked, to be blunt, to sit there and give some money because to help Greece, and they sit there and say, Greece is a country in which they historically don't pay taxes, sit there and ignore a lot of things. Many of the people there are government employed. I mean, do you feel really that this European Union is going to be a union after all, and it's going to be all for one for all, and there's not going to be great upheaval?
It's going to be very difficult to imagine any currency replacing the euro in a country like Greece. It's not that it couldn't happen, but it takes an even stronger currency to replace what is perceived to be a weaker currency. And Tim's point about the euro as a trade zone has performed pretty well. And so I think ultimately it's going to be a matter of the fiscal situation in Greece getting better long term. It may take a long time, but this is a country, you mentioned that they've had trouble in the past. They've been in default half of the time in the last, say, 150 years since they've been independent. So it's been, I've been kind of half joking, this is a country that peaked in about 500 BC, and we shouldn't worry about it. It's a very small part of the economy, but yet the problems in Greece have spilled over to other countries in that part of Europe. And all of a sudden last year you're looking at, borrowing rates in Italy going to 7.5%. That's a huge increase in the cost of financing anything, and whether it's the public sector or whether it's in the private sector. And so ultimately the markets are voting in all this sort of thing. We can talk about elections, but markets in the end are more important, I think, than the ballot box. And markets are clearly saying that they're worried about these countries and their ability to continue the way they've been.
Well, I'll come back to you in just one second, because I want to ask you, Bob, in a recent presentation, you commented that you saw no sign of an immediate recession as China continues to have very nice growth. Has your view changed recently based on what appears to be a slowdown in China, and might that affect, general dynamics?
No, I don't think so. I think the Asia in general has weathered the issues in Europe fairly well. There's no question that exports to Europe have slowed down. We heard that from a number of companies in the wake of first quarter earnings. But overall, it appears as if many of these Asian economies are transitioning more towards the consumer and consumption side of their economies. Many of them raised interest rates. We're starting to see interest rates come down. So we've got more accommodative central bank policies right now, which I think are enough to stem any risk of recession at this point.
Well, thank you. And David, in reviewing your stuff before we came on, I see that you run a rotation emerging market fund, a very successful one, I might add, but I noticed that it was without any kind of restrictions whatsoever in terms of the percentages in any kind of if you want to call it asset class. How did you determine its composition? Is it sector rotation, country rotation, or a combination of both, or something completely different?
Well, it's sector rotation. We follow the Dow Jones sector indices for emerging markets, which looks at the IMF's definition of an emerging market. We use ETFs to capture that composition. EG Shares is kind of the emerging market sector firm that sponsors those ETFs, and we're really focused on the sector, not the country. If we had to, we would leave that kind of decision up to people as smart as Tim. We're not as smart to get the country right. As far as the sector, I think here's something that both Tim and I and everybody up here would salivate over. In our firm, we look at it, the analogy we use is the hunting dog, kind of a happy dog running around, but once it finds its scent, it's jumping up and down and turning around. Our scent is dispersion, and at the sector level, we see significant dispersion in the emerging markets. We've also aligned ourselves with a quantitative shop, actually locally here in the Newton area, F squared, to give us our signals for the sectors. And it's a momentum-based quantitative model, very simple, elegant model, though. And the strategy there is we could be 100% invested, we could be 100% in cash, but the methodology makes a probabilistic estimate of whether a sector is going to make money or lose money. And if it's going to lose money, it's removed entirely. It's a binary decision. And as we were going through the math and looking at how this has worked, again, using the hunting dog analogy, our tails really started to wag.
Oh, thank you very much for that visual.
I like that.
And Tim, you have a very interesting, emerging market website, and I'll sit there and give you credit for it because I think it's spectacular. It's called emergingmoney.com. Okay, that's it for the commercial. And there you typically lay out weekly strategies. Well, okay, it's the start of a new week. We see what's going on. I'm just dying to know what you suggest we do at the moment, because people always say, thanks, great panel, lots of information. But what the heck do we do? Because I want to know what we should do right now in the emerging market portion of our portfolios. And we'd like you to share with us as well, as long as there's reasoning behind it.
Well, thanks for the advertisement, and all I would say to all that is it is important, and as Dave said, dispersion in emerging markets is something we're all striving for. And I think the days of the entire asset class going up 30 or 40%, or even 15 to 20% together are done. The BRICS have been death, and I think people that have looked at that as just an allocation trade and walk away realize that not only are these 4 different countries with 4 very different dynamics going on, but that growth in the world for Brazil, and Russia is different than it is for China and India. On some level, if they could, aside from getting funding from the rest of the world, would close their borders, is the way it appears to me as an investor. So bringing it back to what do I like here? I do like Brazil here, and here's why. Here's a country that if you ask Brazilians, they'll tell you that their currency has been probably 2 to 3 times too expensive over the last couple of years. As an economy, it's made the Brazilian economy, which everybody thinks should be this manufacturing and commodity paradise, unable to compete, actually. And so moving the real from 153 to what is now 190, and a central bank that has kind of been telling you through their intervention in the market over the last few weeks that actually they might like it a little higher. You're getting to a place where the economy is very, very interesting. The problem here is that all of the sexy sectors that everybody probably in this room have been sold on with Brazil for the last 5 years have also been death. I mean, the mega caps in Brazil have been death. Petrobras is death for obvious reasons, in the same way that a Gazprom or a PetroChina are. But Vale's been a problem because they also, too, are a state company that's been getting taxed and squeezed the whole time. The banks, everyone universally accepts as being some of the best banks in emerging, if not the world, that have already gone through their credit crisis. But they actually have some bubbling up of some credit concerns there, too. The home builders are maybe have been the sexiest sector. Names like Gafisa and some Morella and some of these PDG. These are names that some of the biggest hedge funds, the smartest guys in the world, have bought unanimously. And these are companies that have been wrecking capital, have seen their inventories rising, their margins going down substantially, and ultimately are in some cases, a couple of these guys are going to go out of business. So the setup here, though, is the following. The currency is very cheap. Inflation has not been this low in Brazil for as far back as I can remember. They're going to take rates to historic lows, and part of the reason for doing this is so that the central bank, they need to bring real rates down in Brazil because this has been the best carry trade in the world. And so by doing that, they're going to actually take away some of these hot asset flows. Effectively, no inflation, rates are going lower, the currency is cheap. You've got a place where valuations are cheap. These are things that we like in general to find in emerging markets to make an allocation to a country. But what I would say, probably similar to some of the guys up here, is I don't come back from Brazil and say, boy, I really need to buy this country. We don't make a top-down allocation, even though we care a lot about the macro and making our bottom-up selections. To me, the best place to invest right now in Brazil are in some of the retailers. Despite the fact that There may be some bubbling credit concerns. I think they're somewhat overblown. You've got 5.3% unemployment. You've got a consumer, you've probably all read these statistics, but 40 million people have moved from the essentially the D class into the C and the B class part of the economy. There's another 40 behind them. So this is a very powerful long-term trade. It's been dead money for 2.5 years. Therefore, I think tactically it's a pretty good time to buy Brazil.
Well, thank you very much, Tim. But the follow-up question, if so, you can grab the mic back if you want, is basically, I like to diversify my portfolio. Brazil, I can't put 100% of my small funds into Brazil. Are there one or two other countries that you really think are up-and-comers in the emerging space? And you can include Frontier if you want.
I think Turkey is one of the most fascinating investment ideas just because we all know from a map it sits essentially on the doorstep of Asia, the Middle East, and Europe. It's been painted with a European contagion brush, even though a lot of its core industrial and service companies or telecom companies are really serving the Middle East, and in many cases serving Russia. I was just over in Turkey a few weeks ago, and I met with a company called Çimsa, which provides auto glass and industrial glass and packaging to places like Russia. They've got a huge plant in Samara in southern Russia, and these guys are just humming away. Turkey grew close to 9% last year. Its problem was an overheating economy, not an economy that was falling out of bed. Emerging market guys and girls always talk about the demographics. This has got the best demographics I can see on balance. You can find younger populations, you can find maybe better educated populations, but you don't find the totality of 80 million people, rising fluency rates, fantastic workforce, some of the best management teams, and very well-positioned demographics. So I really like Turkey a lot. They have huge current account deficit issues, which I think are somewhat overblown. Their banks are some of the best in the world. They have been through very difficult times, and if anything, again, the central bank in Turkey has been trying to calm their growth down. But these are, Garanti Bank is one of the best banks in the world, bar none. Some of the industrial names, we own a company called Frodo is the ticker. It's Ford Otosan, which is the local producer of Ford products into Europe and into the Middle East. And this is just a great company. It pays a 10% dividend yield. A lot of the companies in this part of the world pay big div yields. And I think your biggest issues have been liquidity spikes or vacuums when this liquidity is taken out of the market. Turkey gets destroyed. And it's a very big liquid market, so therefore it's a market that global macro guys will be able to press buttons on and push it around because they can, because there's liquidity there. So they'll short Turkish futures because it's a big liquid market, and Turkey will sell off. So you have to be very careful about the volatility of this market. But fundamentally, I think it's a great place to invest.
Thank you. I'm glad I have your business card. When I tell my boss I want to invest in Turkey, I might have to have him call you because I certainly am going to be looked at pretty funny, but we'll see what happens. And Mark, at MSCI, you created the first investable emerging market index, 20 years ago?
87 was did the work, launched in 88.
Okay, now why did you decide at that time in emerging markets, and did people at the time look at you like you were crazy?
So I just want to know why when you said Frodo, you didn't say Middle Earth. That would have been perfect instead of Middle East. Sorry. Good now. So when we started the emerging markets, 87, that was a long time ago. MSCI was part of Morgan Stanley, run independently, but I've got to tell you, the broker-dealer side really didn't want us to launch emerging market indices. And literally, the program trading desk said, you're launching these things, our clients are going to buy them, we can't do it. So there was a lot of institutional pushback. But the reason to invest in emerging markets, I believe, is they may have a higher expected return. I'm not so sure they do. Depends. There's not a lot of history, but it's the classic diversification argument. And there's been a number of comments today and recently in the press, media, about diversification has gone away. And I think my opinion is it's just misunderstood. So you invest in emerging markets not to avoid meltdowns, but to capture whatever risk premiums you can capture by a broader opportunity set, and that makes sense to me. I made the comment about growth rates before. If there's if the growth is higher than expected, then like it has been recently, then emerging markets have done really well. So if you have positive surprises, that can be translated into higher expected returns. But look at valuations. I mean, valuations were cheap a decade ago, and they're not so cheap now. Also look at the components of the stocks there. Growth in GDP is one thing, but a lot of that growth is translated into U.S. and other foreign companies investing directly in emerging markets. So I love emerging markets. I'm overweighted because the correlations for a U.S.-based investor is lower than versus the developed markets. So I'm overweighted emerging markets. I love emerging markets, but not because I necessarily think they have a higher expected return. It's just a diversification argument. And I guess one last point is that if you look at the correlations, not of the market, but of risk premiums, as a U.S.-based investor, tilting internationally to small in value has almost zero correlation. So it's a very powerful if you take that perspective.
Well, thank you. And we'll entertain any questions from the audience if we want.
Two totally separate questions. One is, can you talk about small versus large cap international, what you like or don't like about each? And secondly, about 4 months ago, there was an article, there was a letter to the editor in Barron's that talked about, compared Greece to Puerto Rico, and it talked about the dynamics of the two, where they both have high unemployment, big debt levels, and it talked about the fact, and a common currency, and the fact that in Puerto Rico they were able to, you saw workers migrate into other states, which is what's happening now in Greece. We're seeing a lot of people apparently go into Germany and other countries because they can, where they're in the euro. Can you play that out? He seemed to think that there was a precedent with Puerto Rico that they got out of their debt, their unemployment came down, less people there. Do you think that's a viable option for Greece now?
Does anyone want to handle that second question? And then Mark, you could take the first because you just created a small cap emerging market index.
Do you want me to start with that? Or
No, you can start with that, and I'll let the other three try to think about how they're going to answer to that question.
Okay, so I because my memory's failing me, I can't remember numbers, but I anticipate that question. So I jotted down some long-term returns. So if you look at emerging markets and you want to tease out from that the premiums associated with tilting towards small, and once again, there's not a lot of history. This goes back to '89. It's interesting because arguably Japan was an emerging market in 1970 when MSCI first started. So the definitions changed. But anyway, looking at emerging markets as defined today, the average return was about 7.7, 7.8. If you tilt it towards small cap, it's about 20. So there's pretty good premium. If you look at the IFA countries, it's a little bit more. It's a lot more dramatic. The average returns, this goes back to 75, was about 13%, and small cap is over 18%. Why is that? Most academics would argue because they're riskier, and you're capturing the risk premiums associated with tilting towards a higher volatility portfolio. But they're very dramatic. Then the question is, can you time shifts between small and large? I would argue not. I think other people in this room would probably disagree with that. But it's very dramatic risk premium associated with tilting towards small in developed markets and in emerging markets.
Can I just comment on that too, and stick these guys with the other question? It's a great point. Small cap EM is very exciting. To us, the best companies, or typically the companies that we think we can add the most value as managers in, are the ones that are roughly 1 billion to 10 billion, and so small to mid cap, but mostly mid cap. So these are proven global companies where you've got professional management teams with full transparency, et cetera. If you've invested in mega cap EM over the last 9 months, you've been destroyed. And I think for the better part of, as Mark's pointing out, for the last 15 years, the MSCI EM is annualized, 7.75 or something like that. The point is you haven't done that well, and if you've been out of the market during certain periods, you've really lost money possibly. And typically investors have bought these markets at the wrong time, especially on the retail side. And if you look at the ETF flows this year in the first quarter, 2/3 of the 25 billion that came back into EM roughly was ETF flow, which I think is dangerous. But anyway, small to mid cap, very exciting. The problem here, and this is for me definitely as a day to day as a hedge fund manager who's got a month to month mark to market, is that you can't sell you can't stop yourself out of something you can't sell. You can't take profits in something you can't sell. So the reason why my fund will never be more than $500 million is because I can't invest in the kind of stocks I want to invest in with liquidity where it is. And if you spent time in emerging markets, we've all seen the days when the sun's shining, but very quickly it can get stormy, and the liquidity vacuums that gets sucked out of emerging markets is as dramatic as you're going to see in any asset class. You can't sell small cap stocks, and that's a big problem. So in addition to being able to do all the research and the work, and you have companies that really have some scale and have some of the greatest things about investing in emerging markets is actually the companies that have survived to this point are leaders in their industry. They're street fighters. They've been through crises. And in fact, in many cases, therefore, in emerging, they also coexist in industries that are oligopolies or that there's high barriers to entry because of infrastructure. So they're in a great position. Those are the companies you want to invest in. You just have to be careful about how large that investment is.
Thank you very much. And Dave and Bob, and a chance of the Greeks for living the Trojan horse story and like going to other countries and just never leaving, et cetera?
I'm having a hard time imagining. I mean, we are beginning to see labor markets getting more mobile in Europe. You do see people moving from one country to another for various reasons. Most of it was actually out of Germany and into places like Spain and Portugal and so forth over the last 10 years or so. But it's hard to imagine the Greeks leaving Greece. Maybe some of them will, but a lot of them ended up here in the U.S. many years ago. So I don't know. It's
And Yankee fan Dave, any comments?
Yeah, I certainly don't see them moving into Germany. That'd be like a Red Sox fan moving to New York. But it's I think, you know, we're talking about a country that we're focused on the last year, maybe 3 or 5 years. And, you know, if you take a step back and look at it historically, it has spent a lot of time in default. But I think you're going to see cyclicality to what happens in Greece. And I think if you think of the euro as a union, there's a lot of blood, sweat, and tears that's been put into the creation of that, even before there was the euro. And that's not going to go away lightly. I also think if you look at the trade union as a whole and where Germany is, I mean, they're exporting less to France than they are to China. It's important to them. And so while I don't see, you know, a move of population to industrialized countries, I do think you see Greece eventually work their way out of it with the help of their neighbors.
Thank you. Yes, please.
Can we hear from the other panelists what countries you might think are attractive? And are they investable right now?
I'll take that one since we're kind of country agnostic. We're really going by, you know, we look at the sectors first. But I couldn't be more excited about some of the economic drivers that are coming out of these emerging markets, or what I think Jim O'Neill has coined, I think properly, the growth markets. You know, again, I come back to China creating, you know, a Greek output every 11 and a half weeks. We're excited about what's happened in Indonesia. You know, we're excited about Uruguay. I mean, if you think about LATAM over the next, you know, 5 years or so, you've got this infrastructure spend. And I think come back to why you invest in emerging markets. You're looking for growth. The overlying, you know, the overweight theme there is demographics. And I think the evolution of the indice, right? I mean, Mark, you created a brilliant indice. It's served everybody that's invested in it very well. And it kind of looks, I look at Mark's index, the MSCI, I look at the Dow Jones, and I think they started very similarly, but 1900s you had, you know, an overweight to, you know, the materials, you had energy, you know, and locomotive. Come out to 1981 as the boomers were starting to get some discretionary spending, and what was the best place to be? It was in front of the consumer. PG, Johnson & Johnson, Colgate-Palmolive, Kimberly-Clark.
Well, one of the questions I have, and I don't mean to cut you off, but we have about 4 minutes. I want to get to this other gentleman's question, is that you mentioned Uruguay and being pretty excited. How in God's name do I invest in Uruguay?
You know, what's happening here is emerging market debt is also an underlying story. It's, you know, the metrics of credit there are showing that there's starting to get more and more demand. And it's a ripple effect from Brazil. That's one thing, but you're starting to see more confidence in the domestic